Here at United Home Teams, we know the San Diego real estate market can feel, well, a little crazy right now. With prices where they are and interest rates bouncing around, it's tough to know what to do. There's just so much noise out there. So today, let's cut through all of it and just look at the data.
This is the big question, isn't it? It's the one we get all the time. On one hand, you've got that fear of buying at the absolute peak, right before a crash. But on the other hand, there's that fear of missing out, the worry that if you wait, you'll be priced out of San Diego for good. It can feel like you're stuck.
But what if we didn't have to guess? What if instead of making one of the biggest financial decisions of your life based on a gut feeling or scary headlines, we could look at history, look at the hard numbers, and get a much clearer picture? To do that, we first need to understand how homes are even valued in the first place.
So before we can figure out if today's prices are justified, we need a quick primer on how properties get their price tag. It really boils down to two main methods, and they each tell us something very different.
The first one, market comparison, is probably what you're most familiar with. It just looks at what similar homes in the neighborhood have sold for recently. It's all about supply and demand, what people are willing to pay today. The second one, the cost method, is different. It asks, what would it cost today to buy the land and rebuild this exact same house from scratch? Now, this is really important. Think of this as the home's intrinsic value, its rock-bottom price floor. Why? Because if prices ever fell below the cost to build, construction would just stop, supply would dry up, and prices would have to climb back up.
Okay, so let's get to the elephant in the room. Anyone who was around for the 2008 financial crisis is looking at today's market and asking the exact same question. Are we just living through another 2006 bubble?
And when you look at this chart, you can totally see why people are worried. This is the San Diego House Price Index straight from the Federal Reserve. You see that obvious peak back in 2006, the big crash that followed, and now a new peak that's way higher. At a glance, it really does look like déjà vu.
So it's really tempting to just look at that chart and say, yep, here we go again. But what if that's not the whole story? What if there's a huge critical piece of the puzzle that's missing from this picture?
That missing piece is monetary inflation. See, to really understand today's home prices, you can't just look at the price of homes. You have to look at the total amount of money itself that's floating around in the economy.
Now take a look at this. The key thing to see is that insane spike after 2020. In response to the pandemic, an absolutely massive amount of new money was created. And when there's way more money flooding the system, the value of every single dollar goes down. So it isn't just that houses got more valuable. It's also that the dollars we used to buy them got a whole lot cheaper.
And this is the absolute key difference. 2006 was a credit bubble. It was fueled by risky, irresponsible loans given to people who couldn't actually afford them. Today's market is a completely different animal. This is a story of monetary inflation, where prices are rising because the money supply itself has exploded.
And you don't have to take our word for it. We can actually see this relationship clearly in the data. So let's put these two things, the growth in house prices and the growth in the money supply, right next to each other. This table really tells the whole story. In the run-up to the 2006 crisis, house prices were growing almost twice as fast as the money supply. That right there is the classic definition of a speculative bubble. But look at the period after 2020. The ratio is almost a perfect 1-to-1, right around 100%. This means that price growth is moving in lockstep with inflation. It's not a speculative frenzy, it's a rational response.
Okay, so a lot of charts, a lot of numbers. What in the world does all of this actually mean for you trying to make a decision in San Diego right now?
Well, when you zoom out, the long-term trend is just undeniable. Since 1987, the U.S. money supply has grown by about 8 times. And guess what? Over that same period, San Diego home prices have also grown about 8 times. Real estate over the long haul has been an incredibly reliable way to protect your wealth against inflation.
So this reframes the entire question we started with. Instead of just asking, is now a bad time to buy? Maybe the better question is this. In a world where the cash in your savings account is constantly losing value, what is the risk of not owning a real asset? What is the true cost of waiting?
Look, the fear of another 2006-style crash is completely understandable. But the data suggests that today's market is a very different story. The big takeaway is that in an environment with this much monetary inflation, hard assets like real estate have historically been a safe place to store value. And by the way, all of the data we showed you is publicly available from the Federal Reserve. If you'd like a personalized analysis for your own situation, please feel free to reach out. Thanks for watching.
Your dream, your journey, our guidance.